Hi everyone, hope you're all doing well, and today I'm going to talk about selling out at a loss. So I've seen this mentioned a few times, especially on a video like yesterday where I talked about Boohoo. Boohoo is a stock that basically if anyone invested since 2017, basically they're down on that investment. So basically myself, I'm down on that investment, and I'm pretty sure most people that watched that video yesterday were down on that position. And there's a few stocks out there that haven't had a great year, especially in the growth stocks that haven't had a great year. And I think that has got a few people questioning whether or not to sell certain positions. And some of the points that I saw made and talk about certain things on the comments on the YouTube video of Boohoo yesterday, and I've even seen it in the Discord that on the Patreon, that a few people are talking about potentially selling certain stocks at a loss. And the reasons they gave for selling them stocks out at a loss, I didn't really agree with. And because it was quite a few comments, I felt like I would address this with the last video in the week. So yeah, we're going to touch on that today. Just to let you know, if you are on the Patreon, there is the US stock market portfolio review for December on there, which is an exclusive content, so do go check that out if you do want to join. Link is in the description. But yeah, we're going to get stuck onto selling out at losses, because I've seen a few comments out there about selling stocks at losses that I don't agree with, and I thought this education video would be a good one to finish the week on. So first of all, down on a stock, without doubt you will be down on positions at some point. Now I think a few people have got used to a stock market that goes up all the time, and now that we actually have a few stocks that go down, a few people are getting a little bit disheartened because they are down on a position. And there's a lot of stocks that are down basically like over the last kind of a 2-year period. Like stocks are down in lower prices than what they were 2 years ago. So there's a lot of people that are in a lot of investments that are down because they're at lower prices than what they were like 2 years ago. For example, a Boohoo that I talked about yesterday, you're only up on that position if you bought before 2017 basically. So there's a lot of stocks down, and I think that's starting to panic a few people that they are down on the positions, and a few people are thinking, oh, I don't want to hold this stock anymore, I'm going to sell it, or this reason is why you would want to sell this stock right now. And you have to accept you will go down on positions. You will have times in the stock market where you go down in positions. There'll be times where you are at all-time highs, and at some point you have to realize that will drop down to being you down on positions. And there'll be times where you're at all-time lows, and you've got to realize there'll be times where you don't sit at all-time lows anymore and you will go up. That's what happens in the stock market. And the big thing is realizing that when you do make investments, particularly for the first 12 months, there's a 50-50 shot whether you go up or down on that position. What you want to do though is plan, okay, anything can happen in the short term, plan for the long term. What I want to do is plan out where I think the company's financials will go. If the financials move in the right direction, over a long period of time, the share price will move in that right direction with the financials. And that's the best thing as being a long-term investor. As a long-term investor, the benefits are always in your favor, because what you can do is you plan for the long term, and over the long term, the financials move in the right direction, the share price will move in the right direction. Short term, anything can happen, but long term, the stock will move in the right direction. And it's same with the same sort of on returns. You know, there's times where you can go 10, 20, 30, 40% down on a position, but that position's never going to go down to $0 unless it goes bankrupt. So you might go down 10, 20, 30, 40, 50%, but the upside on a lot of the stocks are absolutely amazing. You can never go more than 100% down on stocks. Going up on stocks, you can go up 100, 200, 300%. So the odds of you as a long-term investor are always on your favor, and that's what you want to do. The more you go long-term, the more you put them odds in your favor as a long-term investor. So you have to realize that at some point, especially the more short-term you go, the chances of going down on a stock are more and more common. The further you go long-term and you believe in the long-term, that was when you actually benefit more as a long-term investor. And that's the big thing. Now, the next thing that I think a few people got a little bit caught up on is trying to time the bottom. You can't time the bottom of the stock. The chance of you exactly know where that bottom is going to happen is impossible. If someone could predict exactly where the bottom of the stock was, you would just load the boat at that one point and you'll be happy and you'd be the richest person in the world. Now, the reason why that doesn't happen, because no one can do it. No one can predict exactly where that stock will go. So don't get too caught up if you are buying an investment and that investment does drop after you buy it, because after all, you've got a 50-50 shot of that happening. And if it does go down a little bit, don't get too upset about it. Don't get upset about it that your position goes down 10, 20, 30%. It's going to happen. You will have investments where you go down 10, 20, 30%. That doesn't mean that isn't a bad investment. That's all short term. And in fact, quite often going down in the in the long term actually, in the short term, sorry, will actually potentially mean you make more money in the long term as well, which is what you've got to remember. Now, one thing that I've seen a few people say is that what you want to do is use stop losses to stop this from happening. I can't disagree more. Stop losses are absolutely pointless as a long-term investor. If you're a short-term trader, if you're a day trader, stop losses are important. I don't do that. And as a long-term investor, you don't want to do that. If I used stop losses for every investment I made, half of my investments would have just been, closed off as a loss. If I bought Tesla, when I bought Tesla and I had stop losses, if I had stop losses at 10%, I would have lost out on a 10x stock. If I had 20%, I would have lost out. 30%, 40%, I would have lost out on an amazing opportunity there. That's what happens with stop losses. Revolve, iRobot, GWPH, Greg's, all them stocks, if I use stop losses, they would have been sold at a loss and I would have missed out on a lot of returns there. There's no point using stop losses as a long-term investor. Stop losses are absolutely pointless because you take that 10, 20, 30% loss and you're limiting, if you believe in that company in the long term could potentially return 100%. So you want to be holding them positions more than anything. And the thing as well is when the stocks go down and if you believe in them, you can make more money on them. Now what's happened here is quite often people have been buying here, and if they go down like this, people question, do I want to hold it? Now the only people that really question themselves when this stock goes down is the people that potentially haven't done the research on it. They're just buying ticker symbols. If you're just buying ticker symbols and then your share price starts going like this, you're going to start questioning yourself. You're going to start questioning, should I sell out this company? Because you haven't done any research. You don't have any belief on, okay, this company is going to bring this in next year. This is how they're going to expand the business model. When they expand the business model, the profit revenue will go up. That share price will follow over a long period of time. If you haven't done any of your own research and if you have no belief in the company, if you have a share price that does this, of course you're going to panic because you don't know what you own. If you don't know what you own, you're really going to suffer. If you have done a lot of research in the company, you'll be a little bit gutted. You might have to, you might just double check and go, just make sure that everything's going fine here. Go back through your notes of your investment and go, yep, everything that they're doing is on track. I'm going to be okay here. And if you've got that confidence because you've researched the company and you have the belief in it, if you actually have a share price that goes like this, then you won't have that panic. And the big thing is if you have the share price that goes like this, the big thing is that you can buy, at this point, this point, this point, and your average comes down. And if your average comes down, then you will make more upside and make more money, because at the end of the day, your belief of where the company will go will still be in the right place, and that will happen over a long period of time because the financials will match it and lift that share price up. And that's the big thing. If you use stop losses, you could sell out a loss, but the thing is you take a loss and all you had to do was be patient and your bull case would have turned out and you would have made that money. It's the same with, and I think a few people have this problem right now, is that, potentially you buy here, right? Let's say you buy here. Let's say you've got no money to buy the dip and you might be down a huge amount. But as long as you pay a okay valuation or ideally a cheap valuation for a company, at the end of the day, you're still going to make upside. Sure, it might not be as much as you could do from averaging down, but you're still going to make up. As long as you buy a great company at an okay valuation or an undervalued valuation, you're still going to make good money on that investment. The only time you ever suffer is if you overpay for a company, because you might just get out break even basically for that. But if you pay an okay valuation or an undervalued valuation, if you buy an okay valuation, you make money. If you buy an undervalued valuation and it just keeps going down and down and down, you average down on the way. That just gives you more and more upside if you have a game plan of where you think that investment's going to be. And that's the big thing. That's the big thing of believing in the company. Getting that, if you have a share price that goes down, which you will have, it's a 50-50 shot when you start buying a company if it goes up or down. And if that happens, you could buy that share price at a lot more cheaper valuations and make more money on that. One thing that I've seen a few people saying, say you're buying a stock at, let's say you start buying this stock at £3 and then it goes all the way down to, like £1, like a Boohoo or something, for example. You go, you could have stop lost, and you could have taken that out and not take that loss going down onto £1. You could have got out at £2. But instead of doing that, what you can do is just bring down your average to £2. If you bring your average to £2, that's basically the same as your stop loss. And then if that company is going to come back in value, you're already break even and you've not taken any losses. And the big thing is, if you bought an undervalued company, it probably will go back up to £3, it probably go up to £4, £5 in the longer term. Sorry, I know this is terrible writing, but I'm rushing it while speaking, you see. So, this is a big thing. You can take a stop loss and take a little bit of a loss out there, but I'd rather get my average down to that stop loss. Get average down, and then within a long period of time, if it's a good company, it will come back to that prices. You don't take a fat L. You don't have to recoup that money in another investment. And then, as well as that, then because you got your average down at £2, when it actually does go up to £3, instead of making a little bit of upside there, now you're making over 100% upside on that one. So that's a big thing. If you're down on a position, the only time you should sell out of a company at a loss is if you think, oh, something's fundamentally changed with this company, not just because the share price is going down. If the share price is going down and nothing's changed with the company, you should be like, oh my, I'm getting this company that I love at half the price now. I want to be buying more of that. That's what you should be doing. That is what you should do as a long-term investor. You should be thinking, oh, I'm getting this asset that was this price. Now down at this price, I'm going to make more money on that. I still believe in the company. And that's why you need to know what you're buying. You need to have the research on what you're buying. I don't believe in buying a company and selling out at a loss if nothing's changed with the company. You want to be trying to capitalize on them opportunities out there, because that is where you make more money. And I've seen that with Boohoo a little bit yesterday. People, talk a bit negative about Boohoo, or, stop losses on Boohoo or something like that. For me, don't like stop losses. And sure, Boohoo share price might have dipped more than what anyone out there would for. No one would be talking about that company going down to that kind of, that £1 range. But then it might be a stock that you don't exactly get anywhere near the bottom from. But as long as you can kind of still get around to these prices, you're still going to be able to average down and make money on that and have a lot of upside. The big thing is, like, if you look at an investment like Boohoo is, I think my average was £2.40, which I still think is a good valuation. I'll still make money on that. But now I've got my average all the way down to even £2 now. I'm going to make more money, I think, in the long term. So it's a big test of having that confidence in the company. And as well as that, as a long-term investor, you don't normally get, if you have an investment and you have belief in the company, and you see a company you love go down in value, that should be a buying opportunity, not something that you get upset about and then consider selling. Only if something's fundamentally changed with the company. That's the only time I would move away from that one. So yeah, thought I'd talk about that one anyway, guys. So I hope it was useful. Have a good weekend, and I'll see you on Monday.